Hey everyone, it's Rick, former investment banker, buy-side analyst and prop trader with 25 years in the game. Today I'm combining positioning, sentiment, and technicals to hunt for asymmetric trade setups. Welcome to Offsides Macro. Hey everyone, I'm going to kick it off with a brief report card on the observations that I've made over the past couple of weeks. The major asset classes that I was focused on were equities, the long bond, the US dollar, and crude oil. Last week I pointed out that despite the continued slow grind higher in equities, that positioning got even more short week over week. But something interesting happened midweek. And I pointed this out in our Discord, and it's a comment that Trump made on Wednesday that I really think changed the picture, and I was surprised it didn't get more airtime. I'm going to read an excerpt of it. After getting to know and fully understand the Ukraine-Russia military and economic situation, and after seeing the economic trouble it is causing Russia, I think Ukraine, with the support of the EU, is in a position to fight and win all of Ukraine back in its original form. He then goes on to call Russia a paper tiger. And then we had this planted leak on Thursday, I believe in the Wall Street Journal, that stated European diplomats warned the Kremlin that NATO is ready to respond to further violations of its airspace with full force, including shooting down Russian planes. Now, I might regret the decision of no longer having the equities on my radar for dip buying, and it certainly could just be a bluff, right, to bring this conflict to a close, but that was enough for me to just be okay with missing a possible trade here. And besides, in a moment, I'm going to touch on how equity positioning is actually no longer in offside short territory, and in fact has now exited the lower quartile. So it's not up quite enough to be on my short radar, but I think the Trump and EU comments combined with this significant delta in positioning has now taken that trade off the table. We're up 1,300 S&P points since positioning got us long in April, so I'll take that as a victory lap. And one more anecdote that I pointed out last week was that the OPI indicative positioning index, and I'll expand more on that in a moment, it was leaning more towards a neutral risk-on position. So ever since these comments hit the tape, despite the decent update Friday, the market really never saw those levels again versus the comments when they hit the tape. Now let's talk about the long bond. I pointed out that positioning was offside short, and that still remains the case. The long bond was marginally down on the week, but I think it's at a pretty interesting technical level, and we'll walk through that later in the deck. The other big one was my observation pointing out the reversal in the US dollar on the FOMC day, and my previous podcast observation pointing out my thinking that the USD hedges could be at or near completion. I think there's a lot of anecdotal evidence that that could be the case. I pointed out that the obvious way to express this trade was via short euro, not just because it's the largest weighting in the Dixie index, but because it was the most offsides developed market currency on the board. The euro was down roughly 0.7 days worth of volatility. And again, as a reminder, I like to speak in terms of multiples of daily volatility because it's irrelevant to use percentages if you're sizing positions properly. I also made a poorly timed observation that lean hogs were offsides long, and that short lasted about 48 hours until I got stopped, but that's what stops are for. Lastly, I briefly mentioned crude oil, and with all these things that I mentioned just previously, heating up with Russia and offsides positioning here, which remains the case, by the way, I think not only the positioning and the action this week, which was up roughly 2 days worth of volatility, remains a really interesting setup. You'll hear me use the term offsides quite a bit. I've written on this extensively, but consider it in the context of a sports analogy. Being offsides is not a place you want to be. Lastly, for the best experience, I highly recommend you open the deck listed in the show notes. The charts and tables that I reference will help you fully connect the dots. Now let's walk through the deck. Join me in the highlighted market section. I like to start off with the equities. Equity positioning rose across the board, and I'll point out that the S&P, Russell, and Dow have all now exited offside short as a group. Equities were in the 9th percentile last week, and now they're all the way up at the 28th percentile. So it's nowhere near time to put on shorts, but this drumbeat of being long equities for nearly 6 months might be coming to an end. We'll see. You can see it in the second set of charts, the dramatic buying in the Russell, week over week. Next, we have a chart and positioning data for the long bond that I mentioned earlier, which remains offside short. And I think it's at a pretty interesting technical level. You could argue it's in the middle of the volatility range, but I think you just have a really obvious stop here. The only currency, if you continue scrolling with me, that I'm going to point out this week is this continued persistence and strength in the Mexican peso, which has been absolutely pinned at max offsides long for nearly 5 straight weeks. Metals, let's talk about copper. Copper is interesting because despite the pullback in late July, which is an understatement, right? The pullback that we got, positioning remains in offsides long territory. It looks like a pretty scary chart to short given this base that it's putting in, but maybe that's why the trade on the short side can work. So I think you need to have that on your screen for weakness. On energy, if you continue scrolling with me, I want to point out and add to what I said earlier. Crude oil positioning continues to drag along the bottom near max offside short. But if you look at the right chart, you can see after 11 straight weeks of net speculator selling that we had pretty heavy buying bar last week, and now we have marginal buying this week. The next chart is natural gas, which I haven't talked about in a long time because positioning has sort of been nowhere. But this has now entered into the lower quartile, not quite offside short, but you can see that there's been 2 heavy net selling weeks in a row, so I think that should be on your radar for a possible reversal. Lastly, I'll continue my drumbeat of pointing out the softs, which as a group is approaching near offside short, but we have both sugar and cocoa pinned at or near offside short, and sugar's starting to show some promise here. It had a decent up week while cocoa was red. Scroll with me to the next section. Let's get to the zeros and ones, which should be your dashboard for the week. I'll quickly walk you through those. If you look at the September 23 column, that's just my percentile based on my look back period for each instrument. And as I mentioned earlier, the equities have now exited offside short. The OPI column is my offsides positioning index that I've written on extensively. This index has very rigid rules, so I'm sort of stuck in the equities despite my spidey sense on that. But if you go down that column, you can see what else is in the index. The SG trend indicator column, I think, is helpful to just see what the trend CTA guys are doing. And there are really no changes week over week. They continue to be long equities and bonds across the board. They're still reasonably short the US dollar, although I recently pointed out that they slowly started to unwind some of those positions, like in the Canadian dollar and the Japanese yen. They obviously will remain long gold and silver. They're long the energy complex, and they're mostly short the grains and short the soft. If you scroll with me about midway through that matrix where the header is labeled last week, this will give you a pretty good snapshot of how each of these individual asset classes have changed in positioning. And as I mentioned, the equities exploded through offside short and are now even outside of the lower quartile. You can see that the grains got reasonably shorter week over week, but still sort of nowhere. The same with the softs. They're nearing the offside short as a group, as I mentioned earlier. Interestingly, my implied USD positioning oscillator, and you can reach out to me if you want a better explanation of how I calculate this, is now at the 34th percentile. Below that, you can see vol-adjusted movers on the week. Standouts include US dollar, the metals, energy, and some select softs. Scroll with me to the final section, the OPI, or the Offsides Positioning Index that I mentioned earlier. If you click on the letters OPI, it'll take you to a brief primer. But what I'm trying to accomplish here, and you can see that it's having a little bit of a small drawdown, primarily driven by the equities, and it's been on this long ride in coffee from 280 up to 420, now down to 380. I can't get out of it because I have to obey the rules that I set out for the year. I'll be doing a white paper on this in Q1 and maybe make the rounds on the podcast circuit to discuss my findings there. But I think it's a really interesting experiment that I don't believe has been done before, so stand by on that. But it's the proof of concept which I'm trying to set out with no motives or no desired outcome. It's pretty promising, though, that we're 3/4 of the way through the year. It looks pretty decent, but we'll see how the rest of the year shakes out. Lastly, look at this OPI implied exposure box. Very simply, what this does is calculate across all offsides positions in the index. What it does is it correlation and vol adjusts those relative to these 4 categories: risk on, risk off, tens, the US dollar, and BCOM or commodities. So let me give you just a quick example. A short position in the euro, for example, has some sort of implied correlation to S&Ps and bonds. bonds, etc. So what I do is I correlation and vol adjust every position that's in the OPI to come up with a rough indicator of what that's telling me in these 4 different categories. I don't have enough data to be confident to tell you that it's a solid indicator, but directionally throughout the year, it's been pretty helpful. Think of it like Hedgeye's quad system, or my brother Sean Bandazian's system that he runs at Cornerstone Wealth, where he runs a macro risk management framework that maps the economy into specific categories using rate of change of growth, inflation, etc. But instead, I'm purely looking at the positioning and letting the market tell me where things could be heading. For example, not only because positioning in the equities were offside short in April, there were many other positions that were in this index that also were telling me to start to get risk on. So I'll continue to track this. It seems like a decent big picture indicator for now. Thank you for coming to Offsides Macro. The views expressed are my own and do not represent the views of any employer or affiliated institution. Nothing discussed should be considered financial advice. This content is for informational, educational, and entertainment purposes only.